So, when you think about our economy, what's the first thing that comes to mind? Probably factories, big machines, maybe skyscrapers, right? But what if I told you that for the biggest companies on the planet, the most valuable things they own are completely invisible? Today, we're going to dive into a quiet revolution laid out in the book Capitalism Without Capital that has totally flipped the script on what makes our economy tick. Let's get into it. Okay, so it all kicks off with this really fascinating puzzle. Back in 2006, Microsoft was, one of the most valuable companies in the world. But if you tried to figure out why using the old rulebook, you'd be completely stumped. The company's physical stuff, its buildings, its servers, even the office chairs was just a tiny, tiny fraction of its total value. So where was all that other value hiding? And this just shows you the sheer scale of the mystery. I mean, look at this. On one side, you have $3 billion in physical things you can actually touch. On the other side, a market value of $250 billion. That is a massive gap. We're talking over 98%. This wasn't just some weird accounting thing. It was a huge signal that the very idea of capital was changing right under our noses. The authors of the book actually call this gap a modern-day miracle. But, it's not magic. It's the result of a quiet but incredibly powerful shift that's been reshaping our economy for decades. It's all about a change in what businesses are investing in and what we as a society actually think is valuable. So the answer to that whole Microsoft puzzle? It lies in the invisible. The value comes from assets that just don't show up on a traditional balance sheet. We're talking about things like complex software code, the brilliant design of a new smartphone, the formula for a life-saving drug, or even just the organizational genius that gets a package to your door in a single day. Right, so economists have a name for these things: intangible assets. They're basically investments a company makes that aren't physical, but are absolutely crucial for its future success. Think about it. Google's most valuable asset isn't really its server farms, it's the search algorithm itself. Coca-Cola's value isn't mostly in its bottling plants, it's in that world-famous brand. These intangibles are the real crown jewels of the modern economy. So, if these invisible assets are now the crown jewels, you'd expect to see a massive shift in where companies are putting your money, right? And that is exactly what the data shows. It's a phenomenon the book calls Capital's Vanishing Act, not because the money disappeared, but because it's taken on this new invisible form. Just take a look at this. This chart shows an absolutely historic tipping point. For centuries, when we talked about investment, we went building physical stuff: factories, machines, railroads. That's that high bar on the left. But look at the right. Sometime around the turn of the 21st century, those lines crossed. For the first time ever, in major economies like the US and the UK, investment in the intangible, in ideas, in knowledge, in software, actually overtook investment in tangible physical things. We are officially living in an intangible economy now. Okay, so why does any of this matter? Well, this is the crucial part. It matters because these intangible assets, they just don't play by the same rules as physical ones. They have 4 really unique properties, which the authors call the 4 S's. And these properties are rewriting the entire playbook for business, for finance, and even for inequality. So let's break these down. The 4 S's are scalable, sunk, spillovers, and synergies. Honestly, if you can wrap your head around these 4 ideas, you'll understand the strange, new world of the intangible economy. First up, scalable. Imagine I own a taxi company. One taxi can only serve one customer at a time. If I want to grow, I've got to buy more cars. But if I build an app like Uber, that single piece of software can coordinate millions of drivers and riders all at once. Intangible assets can be used over and over and over again at almost no extra cost. And that creates the potential for explosive growth and these winner-takes-all markets. Second is sunk. So if I build a factory and my business goes bust, I can still sell the building and the machinery and get some of my money back. But what if I spend millions on research for a new drug and it fails its clinical trials? That money is just poof, it's gone. It's a sunk cost. This makes intangible investment way riskier and a lot harder to get a traditional bank loan for. Third, we have spillovers. And this one is huge. Ideas are just leaky. When Apple spent a fortune developing the iPhone, they didn't just create a product, they created a whole new market. Competitors could just watch, learn, and then build their own versions. Unlike a physical factory, it's really, really hard to stop the benefits of your great idea from spilling over and helping out your rivals. And finally, synergies. Intangible assets love to work together. A perfect example is Walmart's big rise in the 90s. It wasn't just because they bought a bunch of computers. It was because they combined that IT investment with another powerful intangible, a totally new way of organizing their supply chains. It's like one idea plus another idea creates something way more valuable than just the sum of its parts.
So when you have an entire economy that's built on these four principles, scalable, sunk, spillovers, and synergies, what does that world actually look like? Well, the consequences are profound. They're reshaping everything from which companies win and lose to the very nature of economic inequality itself.
Yeah, that whole scalability thing, it directly fuels the rise of superstar firms. I mean, think about it. When one search algorithm is just a little bit better than the rest and can serve the entire planet for free, why would you ever use the second best? This dynamic leads to incredible concentration, where giants like Google, Amazon, and Facebook can dominate their fields in a way that old industrial companies just couldn't. And that affects all of us, the choices we have, the opportunities for smaller businesses, everything. And what this does is create a growing divide, not just between people, but between companies. We're seeing this widening gap between a small handful of super productive frontier firms, the ones who've mastered intangible investment, and this long tail of laggard firms who are just falling further and further behind. This helps explain that weird paradox of seeing amazing innovation in some corners of the economy, while overall growth feels kind of sluggish. This also helps us solve a major economic puzzle that economists call secular stagnation. For years, it's been incredibly cheap for companies to borrow money. You'd expect that to set off a huge boom in investment. But that boom never really happened. Why not? Well, the intangible economy gives us a pretty big clue. If investments are getting riskier, remember sunkenness, and the benefits can just spill over to your competitors, well then businesses are going to be a lot more cautious, even when money is super cheap. So it's pretty clear we're in a whole new economic reality. The problem is our institutions, our laws, our financial systems, our ways of measuring the economy, they were all built for the old world, the world of tangible stuff. And that presents us with a whole new set of challenges for the way ahead. These are the really tough questions we have to face now. Our banking system is designed to lend money against physical things, not ideas. Our patent laws are struggling to keep up with how fast things are changing. We need to figure out what kind of infrastructure, not just physical things like cities, but social things like trust, is needed to help ideas really flourish. This isn't just some academic debate. This is about the future of our economic growth.
And that leaves us with the ultimate question, doesn't it? This shift to an intangible economy is creating enormous wealth and incredible new technologies, but it's also fueling some serious inequality and instability. So, the big challenge for all of us, for policymakers, for business leaders, for all of us as citizens, is to figure out how to build new institutions for this new reality, to make sure that the prosperity being created by this invisible revolution is something that can be shared by everyone.